Investor capitulation has kicked off. But what exactly is capitulation? Inflation continues to skyrocket and the Fed raises interest rates. How does all of this affect Bitcoin? We'll cover all of this in today's analysis. In the weekly time frame, we can see that the price of Bitcoin has continued to drop. Last week, from June 6th to 12th, an important resistance zone was lost between $27,000 and $29,000, which also converged with 0.61 of Fibonacci's extension. That candlestick was full-bodied, an engulfing candlestick that managed to close below the support zone and has derived from a continuation movement. That movement has caused the price to also lose the intermediate support zone and therefore head towards the $20,000 zone. In this chart, we can see the strength of certain candlesticks, such as the one from May 9th to 15th and the one this week from June 13th to 19th. We already discussed in our previous analysis the possibility of a crossover between the 20 and 100 period averages. As we saw, if this crossover occurred, the movement could intensify, which has eventually happened. Moreover, after losing the area of $27,000 to $29,000, the price has also lost support areas in which there were liquidity gaps and is now in search of the 200 period moving average in the weekly time frame. Something worth highlighting is that we're currently in a very important oversold zone. The RSI has lost the 27-point area, the strongest oversold zone in Bitcoin's history. This oversold zone has caused investors to sell at a loss. We'll be discussing this later, so be sure to stick around till the end. Now, let's move on to the daily time frame. As we saw in our previous analysis, a structure started to form from May 11th to June 11th, a range that lasted a month in which we mentioned the possibility of a distribution movement between $28,000 and $31,000. In fact, a parallel channel started to form. Within that parallel channel, which tends to involve continuation movements, as we saw, certain fractalities took place. What we can see in blue is a fractality mentioned previously, which eventually became a distribution pattern. Although let's keep in mind that this movement has been so profound due to fundamental factors which we'll be covering later on. As we can see, the price began to lose the parallel channel and confirmed that distribution on the 12th with a full-bodied bearish candlestick. This was affected by the previous publication of the inflation data, given on the day of the publication, the 10th, Bitcoin unlinked itself from the SP 500 index and reconnected later on. As we can see, the price crossed the support at $24,000 to $25,000 with great force as fear took over the crypto market due to the news around Celsius, which we'll also be discussing shortly. On the 13th, Celsius Network blocked its investors' assets on its DeFi protocol and carried out some movements with its positions which didn't calm investors down. Now, the price is approaching that important support zone at $19,800, a zone of highs in the previous cycle in 2020. If we display the moving averages, we can see how this trend line has gained strength. They've inverted and separated themselves. But let's keep in mind that it doesn't involve a natural movement, as a number of fundamental aspects have had a direct impact on the price of Bitcoin. In the oscillator compound, we could see a divergence forming, so we'll have to keep a close eye on the price action to see if it pulls back or ends up touching the 17,600 and 19,800 support area. In our previous analysis, we also discussed this fractal of a larger scale accumulation pattern derived from the smaller scale distribution pattern. The sprint could take place in the lower part, as opposed to the sprint by the superior part that occurs in a distribution. If this accumulation occurs, it could even be extended over time. There is no estimated time, but the lateralization could take time if we take into account the divergences and the oversold situation. Now, let's look into the SP 500 chart to see how traditional markets have reacted negatively to inflation data, as well as the Fed's decision to increase interest rates. In the SP 500 index, we can see that bearish trend line in which we can observe that it was being used as a rejection zone. The index formed a symmetrical triangle, and after breaking the structure, a bearish continuation movement was carried out. And the candlestick on June 9th had already started discarding the possibility of negative inflation data. The opening of the market on June 10th created a huge gap which confirmed the disastrous inflation data. Later, the index lost the 3,800-point zone due to the likelihood of the Fed raising rates by 0.75 being leaked by Wall Street Journal, and the market discounted it. On the 15th, when the rise of the rates was published, it generated volatility in the market, creating that doji candlestick of indecision, and yesterday it continued its downward movement. And now it's at the next support zone of approximately 3,650 points. The dollar is at levels unseen since 2002, breaking the upper part of that parallel channel that has been forming for several years. Amongst other reasons, this interest in dollar is due to the sale of capital from the 10-year Treasury bonds. In addition, the dollar's momentum is also due to the continued sale of shares on major exchanges. And something important to keep in mind is that the forceful decision of the Fed to raise interest rates can be seen by some investors as positive news to avoid the devaluation of the dollar, and therefore many of the investors could be choosing to take refuge in this currency. But beware, because on the RSI, we see a divergence from April 29th to June 14th, and now it could be heading to the downside of that trend line. On the other hand, if it continues its upward movement, it could go towards the area of 109 points. And now let's take a look at the Fear and Greed Index, which reveals a situation of extreme fear and has reached 7 out of 100 points. This week has been influenced not only by inflation data, but an issue regarding the Celsius network. The cryptocurrency banking and financial services company halted all withdrawals, exchanges, and transfers. According to the company, this has been provoked by the market's extreme conditions. However, wallets display a transfer of 3,500 bitcoins to the FTX exchange. The Celsius token dropped drastically until reaching $0.18. There have been concerns about Celsius' high yields and its connections to Terra. In addition, last year, after taking a loan of $500 million, the CEO of Celsius, Alex Mashinsky, assured that if Bitcoin fell in price, they would receive a margin call. But we have been able to see how Celsius has liquidated part of that loan on MakerDAO, sending DAI and wrapped Bitcoin, and now its liquidation price is at $13,600. And speaking of margin call, the MicroStrategy company, known for being one of the companies that owns the most Bitcoins, has ruled out the possibility of a margin call being applied. MicroStrategy has a loan granted of $205 million, which is backed with 19,000 Bitcoins. And in recent months, there's been fears that if Bitcoin continues to fall, the company that has lent it those $200 million, Silvergate Capital, will put that guarantee into action to ensure that MicroStrategy repays the loan. But the CEO of the company, Michael Saylor, assures that they had already foreseen such a situation and that they will continue to hold Bitcoins as part of their strategy. Bitcoin would have to drop to 3,600 to be liquidated. In the macroeconomy, bad news has made headlines this week, especially that surrounding inflation, which, by the way, we'll drop in a video right here in which we explain in detail how inflation affects markets and the role central banks play. Now, let's look at industrial production in the Eurozone. Industrial production only contributes a small portion of the GDP, but it is highly sensitive to interest rates and consumer demand. This makes it an important tool for forecasting the behavior of the economy. In April 2022, industrial production fell by 2% in the Eurozone compared to the same month of the previous year. Now, let's take a look at Producer Price Index. This index measures the change in the price at which producers purchase goods and services. Instead of looking at the price from the point of view of the consumer, it does so from the point of view of the seller. But of course, if the seller pays more to produce their products, he will end up passing these costs on to the consumer, and that is why we use it as a reliable indicator to measure inflation. In the month of May, the Producer Price Index was somewhat lower than expected, although it stood at a worrying 10.8% year-on-year. Furthermore, if we exclude energy and food from the index, which gives us the underlying PPI, the figure is 8.3%, a somewhat better figure than expected. Retail sales do give us a worrying figure, but it converges with the hawkish stance adopted by the Fed. May is the first month so far this year in which retail sales fall. This is a bad sign because it suggests that the economy is slowing down faster than expected after the Federal Reserve's decision to tighten monetary policy. But the breaking news this week involves the Federal Reserve's decision to increase interest rates by 75 points. In our previous analysis, we saw how inflation has shot up in the United States as well as the Eurozone, which could encourage central banks to make drastic decisions. This decision was made first and foremost in the United States. This week, Jerome Powell announced the decision to increase interest rates by 75 basis points.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point.
But the forecast is that in July, another hike will be carried out. And let's not forget that given these measures have a direct impact on the economy, we could fall into a recession that obviously affects all markets, including that of cryptocurrencies. The forecasts for this year and the following have worsened in this last month. The GDP growth projection for this year is at 1.7%, and until very recently, it was thought that growth was going to be 2.8%. As we can see, there has been a significant change of heart, and most importantly, interest rates are expected to come in at 3.4% this year from their previous forecast of 1.9% in March. And now let's move on to the on-chain analysis and take a look at the information provided by the blockchain. As we discussed in our previous analysis, we had a chance to break the 0.6 oscillator at the Mayer multiple, confirming the distribution in the price of Bitcoin. This suggests that the price of Bitcoin has only spent 5% of its history below this oscillator, coinciding with accumulation zones. In this chart, we can see that the price has broken through the realized price, which is the average purchase price of unspent Bitcoins downwards. Here we can also see the MVRV, which tells us when Bitcoin is undervalued. Right now it is at 0.96, which reveals an undervalued zone. But in addition, statistically, this point has hinted at the start of an accumulation zone converging with the Mayer multiple. In this volume profile chart, we can see how the price has been distributed and how a very important cluster has been created in the $20,000 area. In the event of losing that zone, the next important volume zone is approximately 18,000, meaning this is the next price zone with the greatest buying and selling interest. And now let's move on to the net realized gains and losses metric, which presents the magnitude of the net realized gains or losses by all Bitcoin holders. The realized profit or loss is evaluated in relation to the price when each Bitcoin last moved. The data for June 13th reflects that there was an amount of realized losses of more than $4 billion. We had already discussed this possibility of investor capitulation in our analysis on May 13th, where we also discussed the possibility of miner capitalization, which we confirmed in our analysis with the hash ribbon indicator. In that analysis, we explained what both this indicator and the capitulation of the miners consist of. And what is investor capitulation? Capitulation is when investors give up any previous gains in any value or market by selling their positions during low periods. Capitulation can happen at any time, but it usually occurs during high volume trading and prolonged stock declines. A market correction or bear market often leads investors to capitulate or panic sell. Now, let's take a look at net exchange position of exchanges, which measures whether there is an inflow or outflow of Bitcoin in accounts linked to exchanges. When the market cycle is on a low, there is usually a large outflow from such accounts as holders purchase Bitcoins and transfer them to their cold wallets. Right now, the indicator reveals that there have been quite a few withdrawals from exchanges over the last few days, which could be interpreted as good news, because it could be a sign that investors are withdrawing their Bitcoins from exchanges as they do not plan to sell them. And last but not least, let's take a look at Bitcoin positions of investment funds. As we can see, large wallets have been accumulating in recent days, so news around the large holders is not so negative. Futures liquidations, as we can see in this chart, intensified on June 13th when the Celsius network news broke. In fact, the largest number of liquidations of this last cycle took place. We're facing a state of extreme fear in markets, in which investors have already capitulated. Additionally, macroeconomic data is warning us of an impending recession, which could keep markets in a corrective phase for longer than expected.